All right, we are still talking about starting up a business from scratch, and today we're talking to Kingsley about taxes and business structures. So we've talked about business structures in terms of risks, and now we're going to talk about tax and business structures.
Yeah, and this time I'll focus particularly on the income tax piece, and then we'll come back to capital gains. So the income tax piece, starting with a sole trader, the big negative there is you are doing the business in your own direct name. So when it comes to tax time, that's going to be in your individual tax return. So all the profits will have to be reported in your tax return, attributed to you. So if this business has gone really, really well, then you're going to have a lot of income in your name. You're going to move up through all the tax brackets, potentially through to the top one. And with Medicare paying 47 cents on the dollars at the top end. So you potentially get the worst outcome with income tax and a sole trader. So again, that's where you would typically see people only doing it if they're doing a bit of a dip your toe scenario and they're not expecting it to turn into a big thing. If it looks like it's going to turn into a big thing, you'll probably need to look at changing your structure. And there's a few issues there you'll need to think about with, again, if it's done very early in the piece, it's probably not too bad, but with it, you could possibly trigger some stamp duty and also possibly some capital gains tax. Your accountant should be able to sort those issues for you, but just be mindful of that. Next structure, as we talked about with the risk side, of course, is partnerships. So partnerships are pretty good in the sense that, of course, you are allocating income across, at least two people. And helping it split. So that's why, as I say, you still find them in the sort of husband and wife scenario. You've got a business you're running together, and that enables you to split the profits. Typically, they'll be set up to being split 50-50 unless you do something otherwise. They do have the ability to allocate the profits differently to 50-50 or one-third, whatever the case might be, depending on how many partners you got, by what's called a partner's salary. But to do that, there must be a commercial reason for doing the partner salary. So let's again say you and I have gone into business, Lou, in a partnership, and you've done all the work. I've been a slacker, and we get to the end of the year. There's been $100,000 profit, and we think, well, it's not really fair that Kingsley gets 50 of it and Lou only gets 50 of it when she's done most of the work. So we might say, well, we're going to pay a $50,000 partnership salary to Louise in the first instance. So what happens there is of that 100, the first 50 goes to you, Lou. That leaves 50 grand of profit that gets split the 50-50. So in the final analysis, you got 75 and I only got 25. But it's got to be done in a sense on a commercial. So we can't, if you did a teeny weeny bit more work than me, we certainly can't go and do a whopper partner salary to you, especially if that gives a really nice tax outcome. The tax man will not be happy about that and might start to poke around it. But it does give, so partnerships have some flexibility, some ability to allocate incomes differently and access possibly lower tax brackets, but got to be on a commercial basis.
So Kingsley, just one question on partnerships, and I do know that this advice is general in nature only. Should you have a partnership agreement in place?
Yes. The interesting thing there again, though, is if it's a pretty small little one, there is in the Partnership Act itself, there's, I suppose you say, a default agreement to say on how things happen. And a lot of people, it's not, despite it being more than 100 years old, it's actually reasonably useful in those sort of small husband and wife or side hustly sort of levels. If you're doing something significant, maybe that's not. But again, if you're doing something significant, I'd be probably saying, well, get out of partnership and get into a company or a unit trust or something. So, but in that in-between level, Lou, if you've got some particularly unique aspects, then yes, doing an agreement would be wise because you might find the Partnership Act pushes you down something that's not appropriate. And again, your accountant will be able to talk you through it. So this is what the Act says on these issues. Do you like those? yes, we do, but we don't like that one, then you could go and do an agreement and say, well, to deal with that issue, we're doing it like this. Louise signs, Kingsley signs, we've got something. Or, and maybe you even should visit a lawyer and get something drafted up professionally because there's a fair bit of money involved. So we've done partnerships, onto companies. Companies now are pretty good because we're talking small business, and so small business companies are getting taxed at 25%. They have a couple of key advantages. So number one, 25%, it's a flat rate. So it is on the first dollar, but it's 25% across the whole lot. I guess if you ultimately end up becoming a really, really big business, you could find it goes back up to the 30, but you could earn many, many millions of dollars and still be only getting taxed at the 25% versus, of course, take the worst case, you're a sole trader, you'll be getting taxed at 47. So big difference. The other good part about that too is when a company pays tax, it stores as a credit. So again, Lou, let's say you and I have gone into business and this time we've decided to do it in a company and the company's paid 25% tax. And now we've decided, we've gone pretty good. We might pay ourselves a dividend. And so we pay a dividend and you get a $25,000 dividend or something like that. And now that's got to go into your tax return. And so you think, oh, hang on, this isn't too good. I've just paid 25% in the company and now it's gone into my tax return. It's going to get taxed again. Well, the good news there is you get a credit for the tax that the company's already paid. So in shorthand, if you're in the, 39 cents tax bracket for argument's sake with Medicare levy, 25 of that's already been paid and you only have to make up the gap. So you don't get double tax, which is good. And that credit can store for years. So we might run this company for a few years before we decide to pay ourselves a dividend. That doesn't matter. Those credits are sitting there waiting for us in year 4 when we finally decide to pay a dividend. So very good from that point of view. Also, you can set them up to be fairly flexible in that we might say, righto, Lou, you're going to have an A-class share and Kings, you're going to have a B-class share. And again, it turns out you've done more work than me. And we say, well, okay, the fair's fair. We should pay a bigger dividend to Louise. And we can say, well, let's do a $20,000 dividend on the A shares. And because you're the only person who owns an A, 20,000 goes to you. And then we might say on the balance, we're just going to do 50-50 on your ordinaries. And so you get fair return for the extra work you've done. So you can do those sorts of things with companies. Where they're not so good, and we'll talk about separately, is on capital gains tax, but we'll talk about that in our separate little video. So that's the main things that come in. And of course, as we've alluded to with our previous one about being into business together, having the company having paid 25% of the tax is often a good thing, because if it turns out one of us is not so good at managing our tax affairs, most of the tax has probably been sorted already, which is a good thing. Over to trusts and family trusts, or discretionary trusts to be more technically correct, have wonderful abilities really for income tax, and that's why they've been very popular with small business people and accountants over the years. It's also why the tax office sort of is forever trying to find a way to have a go at them. But the great power that they have is if you set up a trust, a discretionary trust, the name is the giveaway, where when we come to allocate the profit, the trustee, whoever that is, has complete discretion on how they are going to allocate those profits. So I've set up a discretionary trust for my family and I'm the trustee. In the first year, might decide all the profits should go to my wife, for argument's sake. I don't need to work out whether my wife did a lot of work or put a lot of money in or anything like that. I can just say, I'm going to allocate all the profits to my wife. Next year, I might decide it should be 50-50, or I'm going to allocate some to my adult child or something like that. And I can just do that. I don't, again, have to analyse who did the work, who put the money in, who came up with the smart ideas. I can just allocate them as I've got complete, as the name implies, discretion on how I allocate them. So that's why they are quite popular in the small business sort of environment. and pretty useful. So you'll still find people fairly keen on those. There's one particular part of tax law that gets very, very complex where we combine a trust and also a company where I can also allocate some of those profits to a company that I might own or be a director of, which is fine, but the tax office particularly doesn't like it if I've allocated $100,000. Let's say there was $100,000 profit, to keep an extreme example, $100,000 worth of profit, and I allocated all to the company, and then I personally go and spend that 100. So I now owe the trust $100,000, and the company's got taxed on it. And of course, again, because the taxman will say, well, hang on, Kingsley, if you'd allocated 100 to you, we would have got more than the 25% on some of that. So they don't particularly like that situation, particularly if it goes on for more than a year in very rough, simplified terms. So just be very careful around it. You'll definitely need to be involving an accountant if you're going to do a mixture, and be mindful there's some pretty tough tax law around that. Last structure you might use would be the unit trust. And that's, I guess, in a sense, much like a discretionary trust, but there's no discretion. It is down to the unit. So again, you and I have decided to go into business, Lou, and you've bought half the units, I've bought half the units, then we're going to have to split the profits 50-50. Very popular with property investments. Mostly there's some advantages more on the capital gains tax side that we'll talk about in the next video, but sometimes quite useful also for a business where people aren't related together. You will also send them in the unit trust. So not as flexible as discretionary trust, but where you're involving people that aren't related, you don't really like the discretion part, because you and I don't want to go. If I say, oh, look, come into this business of mine, I'll be the trustee of the discretionary trust. You put in half the money and then I never allocate you any profits. You want to know that if I put in half the money, I'm going to get half the profits. That's where a unit trust comes into play. And that's, there's obviously some exceptions and technicalities and whatever else to the structures, but that's the main thrust of how they all work on the income tax side.
And guys, again, if you would like to download some more information about business structures, we do have a free download. It is general advice only in nature. For more personalised advice, book a session with Kingsley or your own accountant to talk about what might be right for you. Just one thing I wanted to touch on before we finish this video, Kingsley. How often should someone talk to their accountant about their business structure, especially if their business is growing?
Well, key things, I suppose, there's probably two key things to say there, Lou, in the sense of, obviously, as you're approaching particular tax brackets, it's obviously good to talk to your accountant. So, let's take that extreme again, the sole trader, and it's starting to go really, really well. And, very shortly, above $45,000 of profit, you're going to find yourself in a tax bracket much higher than the company. So, you'd be sort of thinking, well, not if I can see that I'm going to make something not terribly much more than even $45,000, perhaps I need to be talking to my accountant to change over to a company. Bear in mind with these things too, though, that you need to have more reason than just, oh, that's great for tax. Tax avoidance is a very complex piece of law, but in very shorthand terms, if you're doing something and the only reason or the main reason you are doing it is for the tax advantage, the taxman could attack that. So, but you'll often find, though, that when a business is in that phase, it's about to employ people, for instance. It's got to the size about to employ people. It's having more and more customers, the risks of being sued are increased and so forth. So there are usually very good reasons other than tax to be switching, say, to a company. But just be mindful that that is there.
Perfect. All right. Well, thank you, Kingsley.